So welcome to our final presentation on valuation methods. And we're now going to consult one of the most respected and trusted sources of data analysis, the value line, to use their data in our models. Traditionally, the value line was often the only source many investors used for data and analysis, along with the company's annual report and other materials, the financial statements and the quarterly reports. It's not the only one. There are others, but I'm a big fan of the value line personally, so I tell you my biases right up front. It's expensive. For the regular one, it's $50 a month, $598 a year. And then there's a few others that you could buy and spend even more, or a few others that you could spend a lot less and only get 600 companies. But the regular one has some 2,000 companies. But you can go to the library, folks. Go to the library, and that's what I do for a fun afternoon. My wife reads voraciously historical novels. So we are lucky we can walk to our library. And I sometimes will take my laptop and get lost in the value line, and she'll pick up 5 or so historical novels, and that's our idea of a great afternoon. Yeah, anyway, I'm a big fan of the value line, especially their timeliness and safety indicators. One study, which ignored the transaction costs and tax consequences, only used their timeliness indicator, just one piece of information. It showed how you would have beaten the market handsomely over a 20-year time period by just buying and selling stocks as they received and then subsequently lost their number one timeliness designation. Now, that doesn't mean it's going to work in the future, but it shows you that they have a pretty darn good track record. So, slide 38. Can you find the following? The value line indicators, the future price projections, the historical data, the cash assets, the receivables, the inventory, the other assets, the description and analysis of the business, the historical annual rates, the insider institutional buying and selling, the amount of debt and number of shares outstanding, the company's financial strength, stability, price growth, and earnings predictability ratings. Okay, you ready? Because we're going to take a sip from the fire hose. We're going to take a look at Johnson & Johnson and Value Line's report of August 13th, 2021. Here it is, the top portion. This is what they traditionally used, these sheets, and this is what you would get when you go to the library. They have since been moving more and more stuff online on their website, which they now have this freemium model, they call it. They give you some stuff for free, and then other stuff they ask you to pay for. And it's a very worthwhile endeavor, in my humble opinion. But look at all this stuff. And we're not even, this is just the top of the page. This is just the top of the page. But here's the price information and volume and the like, and they have these other indicators. There's the time limits and safety and technical, and the 18-month target price range. Interesting. What it's going to be worth in a year and a half. What it's going to be worth in 3, 4, 5 years. Remember we said, I don't know what it's going to be worth in 3 or 4 or 5 years. Well, neither does the value line. That's why they give you a range. But you go back in time, and they're pretty darn good, folks. They have a pretty darn good track record. And then remember, we were looking at the dividend growth rate. Well, we'll go back, we'll do 7 years worth of data, back to 2015, and calculate the dividend growth rate using these numbers. And then here, they are telling you what they believe the growth rate of the dividend will be in the future. Not only the dividend, the sales, the cash flow, the earnings per share. And then they go into the big numbers, millions. Yeah, capital structure, institutional decisions, buying and selling of insider trade, of insiders, total returns for the stock over 1 year, 3 year, 5 years. It's a sip from the financial fire hose. And so we're going to highlight, we highlighted because this is the data we're going to use for our model, the stock in 3, 4, 5 years, and the dividend growth rate. And let's take a look at the bottom. Notice they even tell you what they believe the dividend growth rate is going to be for the next 4 or 5 years or so, 6 years. And they've computed the dividend growth rate historically for 10 years, and for 5 years, we're using about 7 years worth of data. And then this is something you must read, folks. Read before you look at any, well, I look at the company's annual report and read whatever you can find, but definitely read Value Line's analysis. And at the end, they'll always say something like, well, we think this is a propitious time. That's not how you say it. How do you say that word? A fortunate time to buy, or, oh, we would wait a little while, or they're always very cagey the way they say things. Well, as for the stock, we continue to think that the position here is warranted for most investors. Yes, it is trading near all-time highs. However, these shares still offer healthy, risk-adjusted 3 to 5 year total return potential. In other words, they're saying, this Johnson & Johnson's not going to make you rich quick, but it has a healthy dividend, and it's a company that's been around for over 100 and some odd years, 130, 40 years. So it's not going to fall into the porcelain oasis. Cool? So this is just one of thousands of companies. When you go to the library, you'll just gawk at all the thousands of publicly traded companies. And so you can see that, yeah, it's not cheap, $50 a month, but you're getting something for your $50. Of course, you go to the library, and it's your tax dollars at work. So, as we said, it's a sip from the financial fire hose. Interspersed among all the mountain of data, did you notice the highlighted historical dividends, the future stock price predictions, and the predicted dividend growth? And there are other models that we talked about that use sales and earnings and cash flow and profit margins. We're not going to do them. Maybe later, you decide. But we're interested in dividends. We're using the dividend discount models. Did you read the company analysis? Yes, please, please, please do so. Because as I said, your humble instructor does not make any decisions about individual stocks without, I'm supposed to be without, I'll fix that, without consulting the Value Line. Now, we're going to take a look at a spreadsheet that uses the data from the Value Line to quickly calculate the Gordon growth model and the discounted cash flow models, right? Okay. So I'm not going to click on that because it doesn't look good in Camtasia, which is the program I'm using to copy this. So I have it keyed up. I have it queued up on the computer here. Here it is. So the shaded areas are the places where we enter the data from the Value Line. And we're only looking at a tiny portion of all the data that Value Line gives us, right? We type in the year, and then it comes back and it calculates the rest of these years. And then we enter the historical dividends per share. Just going back in time, what the historical dividends per share is. And you might notice that this number is different because that's because Johnson & Johnson just raised their dividend yet again. Okay. And then we calculate the dividend growth rates. And it's not that hard to do, but we're not going to show you how to do it. I mean, you can do it manually. In fact, we'll discuss it in the what's called the bonus assignment, which may or may not be a bonus assignment. I really haven't decided yet. But considering it, you can get the Value Line for free for some of the stocks, the Dow Jones Industrial stocks, the 30 stocks, they give them to you for free. At least they used to. We'll check to see if they're still doing that. And then there's a way you can go to the library. That's why you're going to go to the library, folks, and have a lot of fun. And then you put in the current price, the predicted price in 3, 4, or 5 years, depending on which we're using 3 years. And then the predicted dividend growth rate. Actually, we're using like 4 years, 2021, 2024. Okay? And then everything else is calculated for you. It calculates the Gordon growth model at 12, 10, and 8% required rate of return using the calculated dividend growth rate for the last 7 years that we did, right over here, the spreadsheet calculated for us, or using the predicted growth rate that we saw Value Line gave us. And notice that the numbers for 12% are a little different. Whoa, a big difference at 10%. And then, wait a minute, we'll discuss this in a bit. That doesn't make any sense. Yeah, it does when you figure out what the problem with the model is. Then we also are going to do the discounted cash flow model using the past dividend growth rate, or the one that we calculated, or the Value Line's dividend growth rate, the one that they gave us. And you'll notice that these numbers are fairly close to one another. They're fairly close because this is calculating the present value. It's not doing that Gordon model, which can blow up if the predicted growth rate is close to the required rate of return, which it is in this case, 7.5% and 8%, then you get really bizarre numbers. Doesn't make any sense. And then finally, automatically, we're going to have the spreadsheet calculate the internal rate of return for either the average growth rate, that what we thought was going to happen, and then the predicted growth rate. And you see they're pretty close to one another too. So let's minimize that. And now let's take a look at the individual slides where we focus in on each one. Okay, so here's the spreadsheet that we saw, right? We saw the putting in the data here, the current price. Now, the Gordon growth model. That's the one where the annual dividends times 1 plus the dividend growth rate divided by the required rate of return divided by the dividend growth rate. And we said the 6.23% average dividend growth rate is what we computed. Value Line is expecting it to be 7.5. So you see, at 12%, we believe it's worth $78. But Value Line's with Value Line 7.5%, they believe it's worth $101. When we go to 10%, we're still underwater here at $120 because the stock price is $167. But Value Line say, no. At 7.5%, the stock is worth $182. So it's actually worth more than what the current price is. But then when you go to the 8% required rate of return, it balloons. Why? Because as we said, as the required rate of return and the dividend growth rate become close to one another, you get a small number in the denominator, which makes the quotient, makes the result really large. So what we're doing here in this last one, where it's $911, we're taking 8% minus 7.5%. That's 0.5%, so 0.5, and that's why the number explodes. In the shaded areas, as we discussed, we enter the historical dividends per share. Just type them. Thank you very much, Value Line. The current price, the predicted price in 3, 4, or 5 years using our judgment, because Value Line gives us a range. It doesn't say a certain number. And then the Value Line's predicted dividend growth rate, just to compare it to what we calculated. And the spreadsheet does the rest. This part is the part that calculated the Gordon growth model predictions. And as we said, note the aberrant predictions at 8% for the Value Line's dividend growth rate. And we said why. Because once these two numbers, the predicted growth rate and the required rate of return, get close to one another, the model explodes. And when they're equal, then the model is worthless because it says it's worth infinity, which is what a concept. If the dividend growth rate is higher than the required rate of return, well, then we have a problem because we're going to wind up with a negative number, and that doesn't make any sense. What we need to do is raise our required rate of return. So the next one is the discounted cash flow models, and I probably should have not included, maybe I'll go back and get rid of the top part, my apologies, because this is really scrunched, and if you're looking at this on your cell phone, you can't see a thing. But again, the computer does all the work for us. We don't even have to look up the present value multipliers. The computer did it for us. And we put in the future cash flows. Actually, it grabs it from the data up here and says at the 10%, it's worth about $174. At 8%, it's worth $187. So, it's telling us that Johnson & Johnson's, a good stock for us to investigate. I think so. I think it's a good one to investigate because have you ever put Q-tips or Band-Aids or Tylenol? And maybe you even have gotten the Johnson & Johnson 1-dose COVID vaccine. And then with using the Value Line's predicted growth rate, because they say that it's a little bit higher, 7.5%, we wind up with even higher numbers for present values. Here we calculated the predictions from the discounted cash flow model using both the average dividend growth rate of 6.23% over the past several years, 7 years. And then the value line's predicted dividend growth rate of 7.5% for the next 4 or 5 years. But they yield fairly similar results. And then our last one, automatically done for us, is the internal rate of return. So here, with both the average growth rate that we calculated and the predicted growth rate, it turns out that we're going to do better than 10%. If we get what we expect to get, we're going to do about 11%, 11.5%, depending on how fast they grow their dividends and what the price of the stock is in 3 years. So the internal rate of return calculations, again, use both the average dividend growth rate and the value line's predicted dividend growth rates, and they give us similar results. As we mentioned, would you consider owning Johnson & Johnson? Have you ever used Q-tips, Band-Aids, Tylenol? What else? They make hundreds of products, and they're very big in the medical device world. Stents that they are for opening people's arteries. Yeah, so they've been around. As I said, they're one of the world's largest, if not the world's largest, medical supply company and pharmaceutical. So, would you consider Johnson & Johnson? Are they going to make you rich fast? No, but unless the world ends, they will give you, I don't expect them to be given 10% over the next few years because stocks are really expensive. We're looking at a big, I don't know when, but we're looking at it because people are getting very euphoric, and usually that's the time. What does Mr. Buffett say? Be fearful when others are greedy. Be greedy when others are fearful. And people are pretty greedy right now, and so we'll see what happens. But just if you're long term, it's a great opportunity to buy more shares. Ay, payano, slide 45. Do we have to use the spreadsheet? It is so confusing. We promised that you could perform all the calculations in this course with a 99-cent calculator, and we have kept that promise. You can do all these calculations manually, but wouldn't you rather bang away at the spreadsheet until you figure out how to use it? It ain't that hard, folks. Just think of it like a big bingo calculator. B3 plus N15 minus G11. It's just doing the calculations that you do on your calculator. The real prize here is that all we need to do is consult the value line for the data to use in our spreadsheets or our manual calculations. And we will hone our predictions because we have to use judgment. But it's exciting. I'm excited. Are you excited? Are you ready? Good, because it's now your turn. It's your turn. Find a library near you that has the value line, or go to thevalueline.com and just download the ones that give it to you for free. Before you go, though, think of a few companies that you would like to research. Maybe downloading their annual reports from their websites beforehand. Ask the reference librarian for the value line packages, and there's huge packages. It's thousands of pages. Find the index of companies in alphabetical order, and the index will tell you which packet contains the company you are seeking. And very cool, the value line groups the competitors close to one another. So they'll have Coca-Cola and Pepsi-Cola and Monster, and all in one little near one another. Pages are right next to one another. So that's a nice way, In a nice way, I want you to get lost. I hope you enjoy this. I really do, because this is what we prudent long-term investors need to do. We need to look at the companies we're interested in, look at their competitors, and think about where the company's going to be in 3, 4, 5 years. And remember that we should never just put the numbers into the spreadsheet and go, okay, I'm buying that stock. Or no, I'm not going to buy a stock. We need to use our judgment. A lot of speculators, traders, they trash the value line. Value line makes mistakes too, just like everybody else. But I would love to see how those traders' long-term results stack up against the long-term results of the value line. Who do you think would have the better results, huh? And folks, as I said, the value line is not the only one. People are making noises about Morningstar. Morningstar is basically copying Value Line. And I haven't used them. I should. I guess I should play with them, but I like the Value Line. What can I say? So, slide 47. 47. Okay, dear students. Once we have finished all our valuations calculations, what should we do? Should we really place much value in our predictions? The answer emphatically is no, 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 no. Rather, we should hurl them into the vast ocean along with the ashes of our dead pets and relatives. Or maybe we should shred them into millions of little pieces and use them as confetti at our next party. Or, my favorite, burn them in a huge bonfire as we dance naked under the full moon. Or you could do all three. Look, we do these calculations to simply tilt the odds in our favor, instead of placing any significance in our predictions. After we have finished, we should ignore them and ask ourselves a very simple question. Do I want to own this company? Do I want to be a partner with the company? Do I want to have a tiny little piece of the company and enjoy the fruits of their success? Mr. Warren Buffett says, look, if you would not want to own the company outright, if you had the resources to buy the entire company and you wouldn't want to do it, don't buy 10 shares. Hey, but if you did want to own this company, if you could own FedEx, or you could own Nike or the Home Depot, and you had the billions of dollars it took to buy the company, great. Buy 10 shares or whatever you can afford, reasonably. Mr. Peter Lynch, in his book, One Up on Wall Street, which is a book you're going to read eventually, hopefully sooner than later, what he would do is he would put all this before internet and microcomputers were just becoming popular. He put everything into a 3-ring binder for each company. And then after he did all his calculations and all his research and everything he's done, all his notes, he would hold it up in front of him and give himself the 60-second, 90-second pep talk or a story, called it the story of this stock. This is company X, and this is why I think they're a good buy and they're better than their competitor, and I'm going to buy it. And he explained all the reasons why. Or I'm ready to sell this stock because the story's changed. They're no longer doing this and that and the other thing, and the other competitors are doing better. So he often, after that 30-second, 90-second discussion, the story, he would have made his decision. So maybe you want to do that. But either way, you're a fundamental analyst now. You are buying companies, not stocks. It's my story, and I'm sticking to it. Slide 48. We'll give the last word to Mr. Seth A. Klayman, a very successful and well-known investor who wrote a book called Margin of Safety. The problem is that it is easy to confuse the capability to make precise forecasts with the ability to make accurate ones. Any attempt to value business with precision will yield values that are precisely inaccurate. We know beforehand that as we make these calculations, there is a 99.99% chance that they're not going to be accurate. They're going to be inaccurate. That's why they call it the future. So why are we doing them? Why do we perform them? These calculations help us identify companies that are prudent, long-term oriented investments. They won't make us wealthy quickly, but they will make us wealthy assuming the world doesn't end. And to quote a very wise client of mine who, after I explained my philosophy and why I think, slow and steady wins the race, he just looked at me and said, look, I don't have to win big. I just have to win. Very smart guy. And that, dear students, is our discussion of fundamental analysis and valuation models. And you now are an official investment guru. You now have been exposed. You've been initiated in the wonders of discounted cash flows and dividend discount models and the present value of future streams of income. And I know the words are stupid and get in the way, but the calculations are pretty straightforward, right? Of course, right. Now go in there, do these presentations over again, do the worksheets over and over and over again, do the assignment, of course, and they're going to be on the exam, the same kind of questions in the same order, and then get to the library or download some of the free value line documents and see if you can start making yourself wealthy. In our next chapter, we'll continue with fundamental analysis by taking a look at financial statements and ratio analysis. Now, you accounting students, don't go screaming into the night. We don't do any accounting. There's no journal entries, no trial balances. We just take the financial statements from the accountants at the firm, the companies that we're interested in, and hope that they know what they're doing. See you in our next chapter on fundamental analysis, financial statements, and ratio analysis. And we are so proud of you, official, full-fledged, card-carrying investment gurus.